Good morning. You should be here for a Crop Economics Outlook 2014 FarmDoc webinar. If you can hear me, you're doing good. If you can't hear me, you don't know it, so tough, I guess. Welcome to our webinar today, and we're going to talk a bit about the crop outlook for the coming year, and in particular what we're going to do is be looking at budgets for corn and soybeans, particularly as they relate to Illinois, and then talk about some of the decisions that are needed to be made. If you want to get a copy of the material that we'll be going over, there's a PDF of the slide set that I'm using here today. So if you want that, you can go to the farmdoc.illinois.edu webinars. You go to that website, you will be able to download the PDF of this set of slides that we're going over today. Also, I would note that there will be a video available of this tomorrow, so we'll process this video. If you go again to that farmdoc.illinois.edu webinars site, you will be able to review this webinar. Again, we're going over Crop Economic Outlook for 2014. I'm Gary Schnitkey, and I'm from the University of Illinois, and we'll be going over that. If you have any questions as we're going through this presentation, type those into the box to your right-hand side of the screen, or at least it's on my right-hand side of the screen, in either the chat or the question box, and we'll get those recorded, and we'll attempt to answer those today. Again, crop economics, here's what we'll be going over today. We're going to be doing two major topics: outlook for corn and soybeans, and one of the big items that are going on this year is a look at corn versus soybean profitability. So when we're talking about the economics of corn and soybeans, we're really going to spend quite a bit of that time talking about what's going to be the more profitable crop, corn or soybeans this year. The reason why that has come up is because of the price changes that have happened relatively or here of late, and those have favored soybeans in a relative sense over corn. So what we're going to do is be looking at outlook again, prices, cost, and then returns by crop. After that, we'll go over some of the decisions that may be coming up in the growing season, late planting, preventive planting, some input recalibrations, and then finally a discussion on capital purchases and cash rents. I put over to the left-hand side of the screen here. You can see this blue box over here on the left-hand side of the screen. That happens to be a screenshot from our management section of FarmDoc. If you go there to the management section of FarmDoc, you'll see this handbook chapter, blue box towards the bottom of your screen. I'm going to point out two particular areas: Illinois crop budgets and historic corn and soybean returns. The material that I'm presenting here today are the budgets, and the corn and soybean returns are both in those areas. We keep those reasonably up to date. We update those budgets and corn and soybean returns at least three times a year. Also note here machinery costs, which is our look at what it costs, the operating cost of machinery. We will be updating those shortly. All right, turning to the outlook, I am now, if I can get this to go forward, showing here a slide. This is the December 2014 Chicago Mercantile Exchange corn price, or corn futures price. This happens to be the settlement prices, and we're going back here from September 2013 up to the present, and this has the price up till Monday on here, so you can see what has happened here to the December 2014 futures price contract over this time period. We started out, or our graph starts out here with September 2013. We were at over 5 here. Over much of the earlier time period, we had a downward trend, and and corn prices were coming down. We reached January of this year, we hit lows of 440, and since then we've been on a nice increasing pace, which would suggest that the market is actually saying that our prices at harvest are becoming, or our market expectations are higher now than they were at the beginning of the year. Yesterday we had a close of 486. That close is considerably or somewhat higher, depends on your point of view, of our projected price, which is used to set crop insurance guarantees. That was the February average. That averaged 462. So we're above that now by over 20 cents. So we're in the positive there. It actually might be, it'd be a good time to think about hedging some of the grain for fall delivery, as we're above that projected price for corn, or projected price for corn on our crop insurance guarantees. But again, if anything, here recently the market has become more optimistic about price. The export demand for corn and perhaps the Ukraine situation play into that. Similar sort of trend for soybeans. We had and again, same sort of graph. We were at $12 back in September, downward trend through February of this year, hitting a low here of 1140, and then we have been moving back higher again. 1178, or 1184 was the close yesterday. That again is higher than our projected price of 1136. So in the recent months, the market for harvest time delivery contracts have been moving higher. Both the corn and the soybean price have moved higher, but the relative change in those corn prices have varied a little bit. We can look at that with the soybean and corn price ratio. This is the soybean price divided by the corn price. As that moves up, soybean price is higher relative to the corn price, and that would favor or cause the profitability of the soybeans to be higher than corn in a relative sense. So as we move higher on this graph, soybean profitability increases relative to corn, and then as we come down, the corn profitability increases relative to soybean profitability. As you can see there, there's been some changes in that ratio. Soybean price increased relative to corn up till roughly December of this year, and then it came down a bit and has been wavering. These soybean and corn price ratios that I'm showing right now are high by historical standards, and that has caused soybean profits to be projected relatively more high than corn, at least compared to what historically we would observe. And again, what has happened is we were seeing soybean prices relatively higher than corn prices. Again, as a result of that, we are now projecting soybeans to be more profitable than corn for both 2013 and 2014. 2013 data is being summarized from FBFM, but overall we expect 2013 soybeans to be more profitable than corn. Again, that occurred because as both corn and soybean prices came down, but corn prices came down faster than soybean prices. Using the prices that we're using in the budget right now, we're again projecting soybeans to be more profitable than corn. This again, the 2013 and 2014 results are a bit unusual. If you look back at history from 2000 to 2012, 11 out of the 13 years, corn was more profitable than soybeans. So the current situation where we're looking at soybeans more profitable than corn is unusual, at least by this historical look at it. One item to note about this, though, is that when we're projecting relative profitability this year, we have relatively little skill in doing that. If we use futures prices in making those projections, what we project in spring versus what actually happens in the fall, you're almost better off using historical average rather than what markets and what projections would say at this point in time. So even though we're looking at that projection now for 2014, that's based on projections, and those projections are difficult actually to make at this point in time. Overall though, much of that relationship between corn and soybeans and those prices will or could be altered by the planting intentions report that will be coming out on March 23rd or 31st of this year. What's included in that report and what farmers say that they're going to plant, we could see that change these relative corn and soybean prices. That raises the question of how flexible farmers want to be relative to their corn and soybeans plantings right now, but that March 31st report could change those relative prices. We will be having a FarmDoc webinar on that from 2 to 3 on March 31st, and that will be led by Daryl Good and Scott Irwin. Overall though, right now Dees corn is at $4.82, or it was Monday. November soybean prices were at $11.75. Both of those prices, if you use those prices to make forecast of market year average prices for the coming year, it would be $4.50 for corn, $11.70 or $4.50 for corn, $11.10 for soybeans. That again is looking at that market year average price from September to August. This is just using that Dees closing price. The range would be $3.50 for corn to $5.50, $9.85 to $13.75. Both of those prices again are more optimistic, at least, than what USDA used at its Ag Outlook. There we're projecting, we're using $3.94 for corn, $9.65 for soybeans. We're actually using $4 for corn and $11 for soybeans in our budgets. Both of those are lower than what the market is projecting right now. In recent months, there's been a number of forecasts that were pretty dire as far as what corn and both soybean prices could look like in the future. Futures markets aren't suggesting any sort of dire sort of situation. In fact, even if you go out into out years, 2016, 2015, we see prices in this range as well. Overall, the market would be saying somewhere in what we're looking at here for prices will likely be the situation for the next several years. Price-wise, we're looking somewhere in the $4.50 for corn. Here's what's happened to cost over time. This data from 2012 are FBFM summaries of farm for Central Illinois farms. This is non-line costs, so these costs are what include all costs: fertilizer, seed, chemicals, drying, storage, everything, machinery cost, overhead cost, everything but the land cost. Those costs have increased over the past several years. In 2006, corn costs were $3.20 an acre. In 2012, those costs were $5.81. We're projecting those prices to come down in 2014, or excuse me, the cost to come down in 2014, and that is primarily led by declines in fertilizer cost. To give you an idea of the importance of fertilizer cost, I have here on this slide a list of 4 costs in red at the top. These 4 costs are the costs that have increased the most since 2006. Fertilizer was the leading one. $200 was the cost for corn in 2012. Roughly the same cost in 2013. that was an $83 increase since 2006. Moving forward into 2014, that cost likely will come down. The other three costs, seed, machinery depreciation, and crop insurance, likely won't be declining. Seed, we're projecting roughly at the same price, a little bit higher. Machinery depreciation's likely to stay where it is or perhaps increase a little bit. Crop insurance is likely to be about the same, maybe down a dollar or two per acre. But overall, the only price that we see coming down here by a significant amount in 2014 is that fertilizer cost. Again, that is being driven by lower fertilizer prices. Here, this slide shows fertilizer prices from July 2008 until the present. On March 6th, and this is fertilizer prices for Illinois, and this is reported to us by the Ag Marketing Service. On March 6th, those prices were reported for anhydrous ammonia at $654 per ton. That is lower than the prices observed in 2013. Over that growing season, most of the ammonia was purchased at prices in the high $800 range. DAP at $558, that is lower than the 2013 price, but as you can see here, DAP has been increasing in recent weeks. Potash, $440. Overall, we might see some of these fertilizer prices increase some as we're moving into the spring period, but still they likely will be lower overall than what occurred during the 2013 year, and we're looking for that $200 per acre fertilizer cost to go down to something in the $140 to $150 range. Significant decline, but still not covering the costs that are the revenue declines that are likely occurring. Here, just to give you a feel for what this looks like, and this slide is a summary of our actual results that is shown on that farmdoc website. Just to show you here, 2010 going down here at the bottom, operator and land returns. This is gross revenue minus non-land cost. We were at 501 for 2010, 2011 630, 570 for 2012, 2013 $277 and $247 projected for 2014. So you can see here those $200 ranges are below what we've had in the past. So we're looking at roughly half the revenue, or excuse me, half the return in 2013 and 2014 compared to 2010, 2011, and 2012. Again, this is operator and farmland return. This is what's remaining to pay both the landowner and the farmer. If we're in a cash rent situation, the cash rent is $300. Farmer would have a negative return in these last couple years. Same chart for soybeans. Again, same sort of thing. We're looking at 444 2010, 444 2011, 2012 407, and then 307 in 2013, and 288 in 2014. Again, we're seeing that those returns are going down in 2013 and 2014, and considerably below the 2010, 2011, and 2012 years. However, if you look at these returns, they have come down less than corn, and again, that has caused the corn, soybean relative profits to change, at least from what they were historically. Looking at budgets right now, these are high productivity budgets, and we're just showing here corn after soybeans here with a 259 return, corn after corn with a 204 return, soybeans after corn 288, and soybeans after 2 years corn 310. But if a field had been in corn in the previous years, our budgets would say it would be more profitable to put that in soybeans rather than corn. And in fact, this year we're projecting soybeans to be more profitable than corn after soybeans at this point in time. That's using an $11 price for soybeans, $4 price for corn, and you can see the budgeted items here, or budgeted yields here. This happens to be for corn, Illinois, high productivity. Our other budgets, we have three other categories: Northern Illinois, Central Illinois. Central Illinois is divided into low productivity, 184 bushel average yield across corn after soybeans, compared to 196 for Central Illinois high productivity, and Southern Illinois. In all of these regions, when we're projecting soybeans after corn, right now we're projecting that combination, soybeans after corn, to be more profitable than corn after corn. These budgets now are using a corn price of $4, $11 for soybeans. Again, that is below where we're at currently as far as what futures markets are suggesting those prices would be. If we use those futures markets and did the same thing, that slide did change. Now we're using a $4.50 corn price, $11.10 soybean price, again closer to what the futures markets are suggesting for fall delivery. We have Central Illinois high productivity budgets, corn after corn coming in higher than soybeans after corn. So we're in our high productivity farmland. Those current futures price would suggest corn after corn being a bit more profitable than soybeans, but not by much either. In our other regions, the soybeans after corn come in more profitable. That is a fairly typical relationship as we move into higher productivity land. For whatever reasons, corn yields react more to higher productivity land than soybeans, and we typically see corn yields increasing relatively faster than soybeans on those high productivity farmland. In any case, right now, what our budgets would be saying, if we use our $4 and $11 price, what we've been using for a while, soybeans more profitable than corn. If we go to more closer to what the futures markets are suggesting, on high productivity land, corn comes in a little bit higher than soybeans, but not by much. So it'll be interesting. The planting decisions, again, soybeans is being projected more profitable than corn at this point, but we have what actually happens does change a little bit from those situations. Now I'm going to turn to some of the decisions that we may be facing here in the next several months. One of the tools that I would suggest that you take a look at is the planning decision model. It's a Microsoft Excel spreadsheet. So it's available in the FAST section of FarmDoc. It's a Microsoft Excel spreadsheet. It has a number of modules in it. It automates the corn soybean comparisons that we have just been doing. It also gives returns by planting date. It has modules to look at preventive planting and replant decisions. So we're moving on into this year. talk about some of the decisions again that we may face. You may find this Microsoft Excel spreadsheet useful. In late planting, if we get to a situation where we're looking at late planting and we've had a field that we were planning on planting in corn, the prices, at least as they're currently looking at, would likely cause a switch quicker to soybeans than corn. So if we're in that situation where we're beginning to wonder whether we should be planting corn or soybeans this year, the prices that exist currently would suggest to make that switch sooner in time. Of course, that's going to also depend on the price response that we may see after that March 31st planting report. And again, these calculations and these comparisons, like you see on the right-hand side of your screen, are automated in our fast planting decision module. Hopefully we won't get to this point, but preventive planting is a situation that we've had. It was fairly prevalent actually the last 2 to 3 years. And crop insurance, if you bought the combo product, RP, YP, RP with exclusion, have preventive planting payments or preventive planting provisions are part of that combo product. And basically what those preventive planting provisions do is you can take a preventive planting payment, not plant the crop. If the final planting date has been reached or has occurred and planting has been prevented by weather or some other natural cause, preventive planting needs to happen because of weather-related sorts of problems. It's not something that should be thought of for any situation other than that. If we reach those dates, which are late or early June for corn, later June for soybeans, and that will vary across the state, and it will vary. Each county will have its different final planting date. If we reach that date, a preventive planting can be taken. Just want to note that preventive planting payment often is an economically competitive alternative to planting. So if we get to that point, think about taking that preventive planting payment. Again, one thing that if anything we observe or I think happens is that more people plant given those preventive planting payments than perhaps should. But again, if we reach that date, think about those decisions and use that planning decision module. We've moved into a lower input, or excuse me, a lower corn price year. That also should require some recalibration of input decisions, and by that I mean you're going to need more bushels to cover the cost of input. Let me just give you an example here of the $20 input, and this might be a rescue spray later in the harvest or later in August or July. We're looking at a rescue spray, $20 an acre. If we have a $5 corn price, we need 4 bushels to break even. If we have a $4 corn price, we need 5 bushels to break even. All that suggests is that now as we're looking at input decisions, what may have been economic on previous years, 2010, 2011, and 2012, may not be so now. In lower price environments, which we haven't had in recent years, 2010, 2011, and 2012 being higher price environments, what we typically observe is lower cost farms are the ones that are the more profitable, and that even extends to crop inputs, fertilizer, seed, chemicals, drying, and storage. One of the most persistent things that you observe is that over time those farms that have lower costs tend to be the more profitable. Again, we're moving back into that sort of environment and looking closely at all input decisions given the lower margins likely as a a wise thing to do. 2013, we are projecting lower returns, 205 compared to more recent years. We have these broken out by northern, central high, central low, southern Illinois. You can see here we were in the $400 and $500 range in 2010, 2011, 2012. We're in the $200 range in 2013. In 2014, we are again in the $200 range. I've given two lines here for 2014. The first one uses our $4 and $11 corn and soybean price. The second column uses $4.50 corn, $11.10 soybean price. Bit more optimistic than the $4 and $11 price, but still $3.10 for corn, $3.10 for northern Illinois, $3.28 for central high, $2.75 for central low, and $1.84 for southern Illinois. We're looking at, in the last several years, at considerably lower returns than in 2010 and 2011, 2012, and that also suggests that moving forward, lowering capital expenditures and lowering cash rents likely are something that we need to be looking at. As far as capital purchases, here's what's happened to power costs since 1995. You can see dramatic increases here from 2006 to 2012. Those higher capital purchases are being driven mainly by larger or more capital purchases. In 2010, 2011, and 2012, farmers had good income, wanted to protect those good incomes from income tax, and bought a lot of machinery. Just to give you a feel for that, from 2001 to 2004, capital purchases or machinery purchases on farm averaged right at $40 an acre. In 2011 and 2012, those same machinery purchases were over $100 an acre. Given that we're going back to a lower return environment, those capital purchases will have to decline in the future, and the quicker that that happens, the likely the more financially stable that those operations will be that make that adjustment quicker. There was a study by the Fed of the 1980s situation. During the 70s, we had high incomes and capital purchases rose to those higher levels. 1980s incomes fell, but capital purchases did not immediately fall, and that did contribute to some of the financial stress that happened out there in the 1980s. So the quicker that power costs come into line and those capital purchases come in line, it's just one of those things that need to happen during this lower revenue environment. The other thing, and this isn't going to impact planning decisions necessarily this year, but as we're coming into these lower revenue environments, and again, in central Illinois, we were looking at revenues that were our operator and farmland returns that were above $400 in 2010, 2011, and 2012. Now we're looking at those at $300. That may require adjustment in cash rents, particularly if we come into this fall and we have prices at the lower end of those price outlooks. If we're looking at corn prices in the $4 range or below, there will be a more definite need for adjusting cash rents downward for the 2015 year. Again, we did not, while 2014 returns were projected lower, we did not see a lot of cash rent declines. We will likely need to see that in 2015. Again, If we're looking at high productivity land and operator and farmland returns near $300, we can't have cash rents above those levels and would have to have cash rents below that levels to exist in the long run. Overall, we're still projecting corn prices to average. A good long run expectation of corn prices would be $4.50 for corn, probably in that $10.50 for soybeans. That puts 2014, or where futures markets are at a near average year. Our $4 corn price that we're using in the budgets to be slightly below average year. But this is sort of the environment that we can expect to see from a price environment for the next several years. Right now, there's relatively even returns between corn and soybeans. $4 corn and $11 soybean prices would cause soybeans to be more profitable than corn. Some of the decisions that we may face, late planting, given the prices that we're looking at, suggest an earlier switch to soybeans. Preventive planting, if we get to that point, taking that preventive planting payment may be an economical alternative. And input decisions, we likely need to recalibrate those input decisions and look at them in a lower price environment. Over time, we will need to reduce capital expenditures, and cash rents will likely need to come down. Appreciate this time. That's the outlook now for corn, soybean profitability. Again, I would point to our March 31st webinar, the day the planning intentions report come out. That could be a significant event, could not be. But we will be doing a webinar led by Daryl Good and Scott Irwin talking about those issues on March 31st. Again, lower returns are projected for this coming growing season relative to what they were in 2010, 2011, and 2012. If you have any questions, now is when we're going to try and answer those. So we're getting those questions up here, and we'll answer them. So if you have any suggestions or questions, we'll look at those now. Here, and I'm reading these as we go, and here's our first question. Besides projected returns, were soybean profits higher than corn? You think this could cause aggressive changes this year? That is the open question, and the question is, will we see corn acres switch to soybean acres? I would expect that there would be some switch from corn to soybeans. I would expect much less of that switch to be occurring in Illinois. Central Illinois have been in the past several years near a 50-50 corn-soybean split anyway, a bit above that. So in the heart of Illinois, that central Illinois area, I would not expect much switch to soybeans. In northern Illinois, you could potentially see a bit more of a shift, but still, those rotations are pretty set. Overall, I would expect a bit of a switch to soybeans in Illinois, but most of the switch, if it is going to happen from corn to soybeans, is going to happen out of the mid of the corn belt, heart of the corn belt, and happen on the sort of on the fringes of that area. Chart 17. We have a question about chart 17. Um, Next question. Do you have any idea where Section 179 is going to wind up? Um, so the Section 179 expensing option allows farmers to farmers and others, anybody that is expensing items to expense those at a much faster rate than is typical. Those provisions that allow large amounts of Section 179 expensing are not permanent in law, but have been extended, and usually towards the end of the year. So it depends on whether Congress is going to extend those provisions or not. So that's simply a political question, and I have no more information about that than anybody else. I would say, though, that even given Section 179 expensing, whether it exists or not, capital purchases do need to be coming down in agriculture, likely due to lower returns. All right, power cost. We had a question about power costs that are in this slide here. Power cost here, this is dollars per acre, and what's all included in this power cost area. This is This is a yearly cost, and it includes the following items: machinery hire, machinery repairs, which would be the second largest cost in this category. It would include utilities, a light vehicle, which is a charge for pickup trucks, and machinery depreciation. So what's included in this power cost is not the capital purchases themselves, but the depreciation that results from those capital purchases. And the way that depreciation is calculated, if we make a capital purchase in 1 year, the value of that capital purchase is depreciated over seven-year life. That is to a large extent why we're saying that those capital purchases, these power costs will not be coming down in 2013, 2014, 2015, because it will take several years of lower capital purchases to lower depreciation and thereby lowering those power costs. So bending that backwards or down will take time. And again, this power cost area is a per yearly figure. Capital purchases get translated into depreciation. All right, I showed we had a slide here with average cash rents. This is an average cash rent for Illinois and what these represent. So we had a question about what these average cash rents represent. These are averages for Illinois, so it's an average of all farmland in Illinois. So it ranges from southern Illinois up to northern Illinois. It ranges over lower and higher productivity classes. Average cash rents have increased from $131 in 2006 up to $223 in 2013. And again, if you look at those averages across the state, they will vary. Cash rents tend to be the highest in central Illinois, right around the Sangamon, Logan County area. Central Illinois overall has some of those counties have average cash rents that are over $300 an acre. And even within a county, for the same productivity, we will see cash rents vary considerably with the same productivity of farmland. So if the average in a county is $300, we'll see some farmland that's $400 and above, and we'll see some farmland that's considerably below that, $200 and below. And productivity is an important factor, but it doesn't explain all that variation. The higher end cash rents likely will need to be coming down in the future, and again that's going to occur because those average cash rents are above the returns that can be generated from that farming operation. So over time, high cash rents will likely be coming down. Again, if you're looking at a long-run situation, 450 corn price, 1050 soybean price would likely be good long-run prices to use in budgets, and those budgets would suggest that some of the cash rents that we've seen are above that can be supported by 450 and 1050 prices. We saw obviously very higher returns in 2010, 2011, and 2012. Those would suggest that cash rents should have been rising in those years, and they were in fact. And now we're moving into a more lower price environment. Another question. Given the lower fertilizer prices, do you think that sprayer equipment purchases will go up despite the need to reduce capital expenditures? All right, so let me read that question one more time. Given the lower fertilizer prices, do you think that sprayer equipment purchases will go up despite the need to reduce capital expenditures? I personally don't believe that we're going to see increases in any type of equipment category for the coming year. Again, that's going to be driven likely more by those lower returns than what's happening on the individual cost component. Again, just the lower returns, the less of the need to shelter income from taxes, as well as just the simple lower amount of funds available to make purchases. Another question. Even though producer returns are projected to fall, what will compel landowners and farm managers to want to reduce rents, especially in very competitive environments? And actually that is a very good question. What is going to cause cash rents to come down in an environment where, one, we haven't seen falling cash rents in a number of years, since the 1980s, and it is a very competitive environment. I think there will be a couple of things that will cause that to bend downward. First are those situations, and this is by far a minority. There are roughly 4% of the farms in this state that cash rent a large amount of their land and have cash rents at very high levels. If a farm is in that situation where they have large amounts of their land cash rented at high cash rents, the returns from that farmland are going to be lower than can be supported by the cash rent. If we're in that situation, there will be large reductions in liquidity very quickly. So farms that are in that situation, that may be dictated to them that there needs to be a reduction in cash rents from a lender perspective, simply because there won't be the need to or the desire to lend money on those high cash rents. So you have those farms that are high cash rent, high percent of their acres in cash rents. The real uh, uh, here's where a lot of Illinois farms are at. Most of their land base is controlled at relatively average cash rents or below. Those farms may have a good amount of their land owned. They may have some of their land in share rents, which will automatically reduce to a lower cash rent environment. And they'll have some of their land rented at average or below cash rent levels, and then maybe one farm at a higher cash rent level. Those operators will be very sound financially, and in fact most farms are going to be sound financially in the coming years. Most farms in this new pricer environment or lower price environment will do fine. But that high cash rent farm actually will be a cash drain on their operation. That operation would do better without that farm being in it. So the question will be, will farms in that situation be willing to give up farmland? And again, if we're in an extended period of 450 or below corn, 1050 or below soybeans, those high cash rent farms will actually reduce profitability and not increase it. This new period as far as cash rents will be interesting to see, because this is actually one of the first times when we will see lower prices and cash rents, and so we're coming into a period of lower prices, and what actually will happen to those operations. If we have an extended period of these returns, though, the high-end cash rents will need to come down. A question on interest rates. Any feel for when rates rise and by how much? That's another good question looking out in the future. We've seen some modest increases in interest rates in the past year, and there likely will be some modest increases in the year to come. However, there is a Federal Reserve under Janet Yellen, new Fed chair, doesn't want those interest rates to rise quickly. So I suspect that interest rates will remain at relatively low environment. There is the concern that interest rates will rise quickly, but there is the other side of that, and that they may be low and choppy for an extended period of time. And just as an example of that possibility, look at Japan, and you would note that they've had low interest rates for an extended period. To what extent does adding wheat to a corn-bean rotation make economic sense? So we have a corn and soybean rotation. When does adding wheat make economic sense? When we look at wheat, and we see wheat budgets in southern Illinois, wheat double crop soybeans is a competitive alternative in southern Illinois to corn and soybeans. So first thing that likely needs to happen if you're growing wheat is double crop soybeans has to be an alternative that can potentially happen. If the soybeans aren't there, part of that wheat rotation, then the competitiveness of wheat goes down considerably. Whether or not wheat, so southern Illinois, wheat double crop soybeans is a competitive part of those rotations. I have my doubts that in northern and central Illinois, wheat double crop soybeans would compete effectively. In fact, whenever we do the budgets, it doesn't. So in a relatively lower yielding corn soybean situation compared to what occurs in northern and central Illinois would have to happen before wheat double crop soybeans enters into that situation. Much of the country doesn't raise 60 bushel beans, so farmers that raise 40 bushel beans have to have much lower land costs, and that is true. As productivity goes down, or we get lower yields, we will see lower cash rents, and we do see that across the Midwest as those productivities go down. Cash rents go down. Again, in Illinois, we've related cash rents to expected corn yields, and as expected corn yields go down, cash rents go down. It's almost a linear relationship. One of your first slides on the corn and soybean price range, is this calculated on a regular basis? I'm presuming we had a question here on this range. Forecast based on for December corn contract 482, that forecast a 450 price in that sort of range. I guess we do not. There was a question about that range. Is that calculated on a regular basis? No. And is it in a spreadsheet that you can download? No. But we could make that available. That we will work on making that happen. No, we don't have a place where we calculate that regularly, but that range is based on a statistical relationship between the futures price and market year average price. We calculated that relationship just to get a feel as the futures price changes, what that would imply about the market year average price. Does liquid fertilizer traditionally cost equal or in the range with the prices that you have quoted for dry? On an active nutrient basis, if you're looking at nitrogen, anhydrous ammonia typically is the lowest cost on actual N that is delivered. Solutions, urea, typically are higher. That occurs because anhydrous ammonia is often the ingredient that's further made to make urea and other fertilizers. So from just a actual N in the fertilizer basis, anhydrous ammonia tends to be the least costly. That doesn't necessarily mean that anhydrous ammonia is the most attractive alternative, but that's just the way that works. DAP and potash, whenever I observe prices, typically are the lowest, and they tend to be lower than can be obtained in liquid fertilizer. But again, that isn't necessarily the only reason that you would consider making that decision. Slide 22 shows a 310 for corn at 450. Has a different number for corn, 450. That's likely there are two different numbers in this slide for corn. One is a corn after corn return, and one is an average corn return. So we took average corn and averaged it over both corn and corn after corn and corn after soybean situation. Another question. This is an opinion question. Do you think farmers will look to reduce tillage more favorably than in past years for economic reasons? So you want my opinion on whether farmers are going to move to reduce tillage because of lower prices. That's a good question as well. Actually, I probably not. Farmers probably engage in the tillage that they think is most profitable. Don't know if I could see see some reductions in tillage, but probably not a lot. What actually you'll probably see is a reduction in tillage if you see more 50-50 corn soybean rotations versus corn in the rotation, because as we put corn and heavier corns in those rotations, you tend to see more tillage. For every dollar decline in profits for operator and rent, how does that translate into expected economic value for an acre of land? So there's a multiple, and so as returns come down, so if we have a $300 return, what you would typically do is capitalize that into a land price. Those capitalization values, or with the interest rates that we sort of use on capitalization, have been below 3%. So as those returns come down, it would be, you know, that whatever the decrease is divided by your capitalization rate in terms of land price, impacts on land price. That probably is being driven, that question may be driven, what's going to happen to land prices given lower returns. So far what we've seen in 2014 is land returns not increasing, probably becoming steady. We've not really seen land prices increase in 2013, become stable in 2013, and largely stable in 2014. Maybe some decreases here and there, maybe some increases here and there. The other thing that besides land returns that go into land prices is the interest rate environment, and I suspect land prices will hold up fairly well as long as we have low interest rates. If those interest rates ever do get away from us and become increasing pretty dramatically, that would be at the detriment to land prices. Do you see cash rents being slow to adjust downward? Yes. I would expect to see some of those land price decreases happening this fall. And I think that the extent to land price decreases will depend on what obviously corn and soybean prices look like in the fall. If we have $4 and below corn prices, there will be quite a bit of pressure on cash rents to come down, and I would expect the higher end cash rents to come down. If we have prices closer to $4.50, there will be, for corn, there will be less pressure on those price land rents to come down, and but there will still be some pressure on the higher end cash rents. The high end cash rents that you hear, you know, it's going to be difficult for anybody to cash flow those in the coming year. I'm looking at some questions. Alright, can you do the math for us on what you are saying now? I'm assuming that rent interest rate effects on land values. All right, so I'm not going to try and do the math. I'll do this. I'll tell you what. We'll write a farmdoc daily post on land values in the next week or so. So in that we'll do the math on what will be happening to land prices. But here's the general relationships. As returns to farmland increase, we would expect land prices to increase. As interest rates go down, we expect land prices to increase. In fact, if you look at what's happened to interest rates over the last 10 years, you could say that has had equal importance in the land price increase that we've seen from 2006 to 2013 as the returns increase had. As we see interest rates go up, we would expect land prices to go down. And we are actually at a point where those interest rate increases are pretty, even modest ones are pretty important as far as land prices. Let me just give you an example. Right now our 10-year Treasury note is about 3%. If that would go from 3% to 4%, you know, that side of the increase, that's a a third increase in the interest rate. Take another example for 7% and go up 1%. That's a much lower proportional increase in land prices. I'll do a little spreadsheet on that, or FarmDoc Daily article on there. Is there going to be an increase or decrease in custom farming operations compared to cash rent? Custom farming operations have been stable at a relatively low number for a very long time. I would not expect an increase in those sorts of relationships. How would you look at a farmland purchase in the current economic environment? Farmland purchases, if you look at them historically, if you look at them in a historical basis, have done very well. If you look at holding that farmland over a long period of time, even if you bought farmland at its height during the 1970s, 80s boom, watch it come down, and have held it to this point, that return has done pretty well. If I were looking at a farmland purchase today, I would say first and foremost you would not want it to be levered too highly. You would be wanting to use the your equity capital to make that purchase, not to get too levered of a purchase on that. But if you have the money, farmland purchases are probably still a pretty good investment. And again, look at the alternatives. If you have the money, are you going to put it in the fixed incomes where we don't expect any sort of reductions in interest rates, which would make that investment more profitable? If anything, we're going to see rising interest rates, which would not make that investment have capital losses, and we're also looking at a lower rates of returns on those fixed incomes. Or do you want to put it in the stock market? Stock market is probably just about as risky as farmland at that point in time. So looking at the alternatives, farmland still does a pretty good investment. can the machinery dealer take part of the hit? Well, machinery dealers likely will have lower purchases, and that's the environment of a machinery dealer. They during higher incomes, they have lower returns. Page 20. We had a question on page 24. The dollars. I think there's questions on this graph. These are dollars per acre. This is a statewide average. Do you see any basis problems? I tell you what, on the basis problem, you ask Daryl Good. He'll be on the webinar on March 31st. Appreciate we have come to the end of our webinar. There's still a number of you on here. Appreciate your time. Thank you for being with us today. It does look a lot more like spring out there today than it did last week or 2 weeks ago. And we'll be seeing planters running fairly soon, in a month or 2 months. Good luck with that. Stay safe. And we again appreciate your time here. And thank you for attending this FarmDoc webinar.